Hello and welcome to episode number 9 of Rapid Rundown, your one-stop shop for last week's most important market-moving news. Alright, and let's jump right in with topic number 1, which is that US stocks hit all-time highs, but then immediately pulled back. US equities reached new all-time highs, but then immediately pulled back on profit-taking pressure, with tech and AI names being the most under pressure. And this may signal the end of the so-called Santa Claus rally and probably reflects the thin liquidity around Christmas and the holiday period and just adjustments in the positioning. But it probably does not reflect a major macro shift. And despite this dip, markets are still supported by rate cut hopes and just generally a pretty strong economic environment. All right, and let's move on to topic number 2 of today, which is that South Korea's pension fund triggered major forex flows. So the Korean National Pension Service, one of the largest pension funds in the world, has initiated forex hedging to support the Korean won. And this highlights how large institutional investors are actively shaping forex markets beyond traditional central bank intervention. And the resulting won strength has implications for emerging markets and their forex liquidity, regional carry trades, and in general just global risk sentiment. And the third news or theme of today is how major central banks are delivering broad monetary easing. So major central banks delivered the biggest monetary easing push in over a decade this year, with G10 central banks shaving off 850 basis points off of their benchmark rates. And emerging markets are no different, with their central banks delivering 3,085 basis points of cuts this year, up from 2,160 basis points last year. And this easing cycle reinforces a liquidity-driven market regime which favors risk assets. However, we are seeing a change of tone. For example, there now being the question of whether the ECB and the banks of Australia and Canada might hike rates in 2026. So we are seeing a change of the narrative. And the fourth and final topic of today is that Spanish and Italian government bond yields and spreads to German bonds hit multi-year lows. So the difference in yield between, on the one hand, Italian and Spanish government bonds versus, on the other hand, German government bonds, so-called Bunds, has tightened to their lowest in a decade. So the spread between Italian, Spanish, and German bonds is getting lower. And this reflects how what is perceived as a risk exposure and what is perceived as a stable asset in the Eurozone is shifting. And I wouldn't necessarily expect this spread to get larger again anytime soon, especially with stronger growth dynamics in Southern Europe. And there's still being a lot of spending in Germany and also other countries like, for example, France, which of course leads to higher yields. Okay, that was it for this week's Rapid Rundown. I really hope you enjoyed. If you're a professional investor interested in robust trading results, check out autotradelab.com. And otherwise, hit the like button, smash the subscribe button and the bell. And I hope you have a great week ahead, and thank you so much for watching.